Thank you, Martha. All right, good morning. Anybody want to join me some more push-ups? All right, we'll skip that. I got a question for you. You're paying what? Do I have anybody's curiosity slightly engaged? Good. On Thursday of this week, who knows what the Federal Reserve did? Lowered rates. Again. So, let's talk about this. Investing in a low interest rate environment. Got news for you, folks. This is no longer 2009, 10, 11, 12, 13, or 14. We're now 2019, 2020. It's time to adjust or perish. So let's talk. You've got two choices. Change it or die. I'm not a fan of Darwin, but in this instance, Darwin does work. All right? Who am I? Well, been a lawyer in the state of Ohio now for over 28 years. Represent some interesting companies, National Rio, Real Flow, Note School, National Wealth Builders. Been an investor myself 27 years. I represent investor clients. I'm privileged to change the law in the state of Ohio 5 times. I've influenced national housing policy on distressed sales twice, working on Dodd-Frank being revised for seller financing, member of Arello, board member of Quest Trust, 1 year and 1 day as a Questie. What a day. What a great anniversary. I've got 2 clients that have made the Inc. 500 with their REI companies. One client's done it 2 years in a row. And I write a newsletter and blogs. So what does that mean? It means I see a lot. I know what's going on across America. I don't practice in just my backyard. So the big boy slide is this. What I'm going to tell you is provided to give accurate and authoritative information with regard to what I'm going to tell you. It's provided with the understanding that I'm not rendering legal, accounting, or other professional advice, particularly psychiatric. If legal advice or other expert professional assistance should be sought or is needed, professional, competent should be engaged. All right. We're investing in a low interest rate environment whether we want to do it or not. What is a low interest rate environment? A low interest rate environment occurs when the risk-free rate of return or interest rate, typically set by a central bank, is lower than the historic average for a prolonged period of time. If we look back 50 years, we will see that the average over 50 years for a 30-year fixed mortgage is right around 7.7%. What do we go get a 30-year fixed mortgage for now? 4.5 on the high side, 3.95 maybe, depends. How many of you bought a T-bill lately? 10-year Treasury, huh? Less than 2%, folks. It's going to take 40 years to double your money. Okay? So, have we been in a low interest rate environment for a long time? The answer is yes. For how long have we been in a low interest rate environment? A long time. You could make an argument since 1983. From 1983 till now, we have watched interest rates set by the Federal Reserve go down, 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 down. One hiccup in the mid-90s, down, 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 down. All right? What does that mean? Well, that means a number of things. It depends upon which side of the equation or what side of the coin you may be standing on. So let's get some basics down. Low interest rates are meant to boost economic growth by making it cheaper, but not easier, to borrow money to finance investments in both physical and financial assets. Cheaper money. Okay? Doesn't mean underwriting criteria should change, but it just means the rate should be less. But we all know that as money becomes cheaper, more of it enters into the system based upon our banking system. Therefore, it does get easier because there's more money. How many of you right now can go raise money now that you couldn't have raised 10 years ago? Everybody should be standing up with both hands waving in the air. Okay, I remember the idea 10 years ago of trying to get Wall Street to look at the housing market. Laughed at. Totally laughed at. Now Wall Street's been in and out of the housing market. So let's talk about the two sides or the three sides of the coin. I'm going to stand on the third side of the coin, which means I'm going to stand on the edge of the coin. And you're going to join me, standing with me by the edge of the coin. And you're going to look over on the head side, and you're going to see a lot of people who are absolutely disgusted and frustrated because $1 million in the bank spread among 4 or 5 certificates of deposit is paying a paltry 2, maybe 2.5%. If they're really aggressive on their rate, they'll push it out and they'll look at a 10-year treasury or maybe even a 30-year. If they go 30-year treasury, they'll get above 2%. 10-year treasuries are like 1.7, 1.8. So that's terrible for the fixed income person, for the person who thought that a millionaire should be able to live on more than 20 grand a year. Low interest rates are a curse. They're a problem. But think about this. What is their problem could be your opportunity. Now, on the other side of the coin, low interest rates could be a blessing. Because as we flip over and we look at tails, we can say, wait a second. It should be cheaper now for me to get capital to do deals than ever before. Cheaper capital means that I should be able to do better deals. Cheaper capital means that I might be able to do more profitable deals. We're going to get into that. So I'm just going to give you some projections of what I see, because the interest rates are like a massive pendulum causing tremendous change throughout all of our society. Minor tweaks in an interest rate can make massive changes in the price of housing, automobiles, credit card debt, stock prices, 401k prices, all that. So this is a pendulum that you ignore at your peril. We see Treasury rates continue to decline. The Fed has continued to lower interest rates. I'm going to flat out tell you, the passive investor, the stay-at-home, fuzzy slipper wearing, remote control clicking, Cheeto eating guy or gal that thinks that they can get 10 or 12% on their money by filling out a few forms and telling Quest to send their money to somebody else for a good deal, if you think you're going to get 10 or 12, you are dreaming. Forget it. Every savvy investor I know is not taking that money anymore because they're getting much cheaper money elsewhere. Why? Because if they're putting money to work, they know that their private borrowers aren't wanting to pay more than 10 or 11%. Larry and Mariska and I were having lunch a few months ago in Seattle with our friend Julie. We were talking about hard money rates in Seattle at being 9%. Hard money at 9%. So if you, the Cheeto-eating, fuzzy slipper-wearing, remote control clicking passive investor, think you're going to get 10, sorry, not this time. Current reality, 6, maybe 7 if you're lucky. 6, maybe 7% if you're lucky. Now, that's going to change a lot of different things. But I'm going to tell you right now, 6% is a whole lot better than 2%. Can we agree on that? So I'm going to give you a word, I'm going to give you a phrase that I want you to think about. Apply it to that person. If you run into somebody who's absolutely frustrated with the pathetic rates of return being paid at a bank on a certificate of depression. You know, I'm sorry that the banks are only able to pay that much. I don't know, but maybe I could do 2.5, 3 times better than what they're doing. Would you be interested in knowing more? 2.5, 3 times better than what the bank's doing. What did I just put you at? 6.5 at the most, 7? That's a revolutionary event for them, and it's a chance for you to finally do some good deals. Because I've got news for you. The market is not what you thought it was. It's staggering. Accountant after accountant after accountant is sending their clients to me going, Jeff, I know you understand real estate investing. I know you see it across the nation. My client in pick the state and the city is struggling. Days on market are going up. They got too much money tied up in a massive rehab. Deals are getting harder and harder to find. Their marketing costs are going through the roof. They're cutting their own payroll. The owners of the company are cutting their own payroll in order to keep staff on. Advertising costs continue to go up. It is that storm that Eddie Speed was talking about a little bit ago. It is wreaking havoc in the I Buy Houses crowd. It is wreaking havoc in the note investing crowd. And I've got news for you. There are fewer good deals out there. There are a lot more thinner deals out there right now. And there's more competition. So you have got to slow down. You've got to be careful on how you deploy your capital. You cannot afford to not slow down. I have watched it countless times. It's the tortoise and the hare played out in the real estate investing world. One guy, God bless him, they have gone to a seminar or 10, and after they finally figured out that they're really going to do this instead of this, and this. By the way, I think the hot trend right now is BRRRR. I was thinking about that today. I think most of those people are going to get bored, not as in disinterested. They're going to get bored as in drilled, as in a bullet going through them, because they're going to over leverage. Okay? But anyhow, they've gone from wholesaling to flipping to note brokering to BRRRR to Airbnb to, okay. So they're just all over the place. They're the rabbit and the tortoise and the hare. And then there's my favorite guy or my favorite gal. Boy, just another day. I'm in my lane, staying in my lane, doing what I do. It's not exciting. It's not sexy. It's not stressful, but it's profitable. Whether you're clipping coupons off of a note, whether you're cashing rent checks on free and clears, stay in that lane. You're going to love it. You're going to be, as it was Nathan yesterday said the phrase, it was Ryan. I'm sorry, Ryan. It was your phrase, keeping some powder dry for the next buying opportunity. So here's what we've got. Some of you are getting ready to start chasing a fake high. You're desperate for a rate of return, and you're going to say, okay, I'm going to go chase this smoke and mirrors deal because, man, he had a nice suit or she looked nice and they sounded good and so on. It breaks my heart almost every week. I hear about another desperado stealing somebody's money on a real estate deal, leaving people high and dry. Cleveland, Ohio got rocked with some guy a few years ago, or last year, by the name of Jason Rose. He's been arrested multiple times for this stuff. It's over and over and over again. I see it almost on a weekly basis. You've got to be watching out for it. So buyer beware. Some of you capital seekers are struggling. Why? You're paying too much for your properties. You're paying too much for your deals. You're paying too much on the money you're putting into your deals because you're not recognizing you now need to invest in a low interest rate environment. And you're underestimating your true cost of being in business. I ask entrepreneurs all the time, what do you budget for accounting and legal? Out of your gross rev, what percentage is budgeted for accounting and legal? Most common answer is a blank stare. Okay? Servicing, if you're holding notes, are you watching your servicer? Are you looking at what they're doing? Because I can tell you right now, they're in business to make money, and they're taking money from you that they may not be taking or should not be taking. Legal, you got to make sure you get the right lawyer, not any lawyer. Bookkeeping, man, you've got to keep your numbers accurate. The market is ripe for fraud. Folks, the first thing I want to tell you, if you've got capital to deploy, you want to worry about the return of your capital. How am I going to get my money back? Then you think about what is going to be the rate of return on my capital. I want the pie back, and then I want the whipped cream. I'm more worried about the pie than the whipped cream. Okay? So you always concern yourself about the security of your principal. How good are your loan documents? How good are your transactional documents? Please, 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 please. If you're the one lending the money, if you're the one putting out the money, you control the documents. Please. Okay? Scam artists abound, overpromising, underdelivering. Folks, if it sounds too good to be true, then it is what? Too good to be true. I've got 2 minutes and 18 seconds, and I want to talk about the fundamentals. Know your risks and strengths. Folks, delegate out your weaknesses. If managing your servicer is a problem, come see me. Know your limitations. If you're good at raising capital, then you're probably not good at operations. Find somebody good at operations. If you're great at operations, you may not be good at raising capital. But stay in your lane. Stay in your lane. Slow and steady will make you rich. If you got nothing else out of the brilliance of what Martha Speed just shared with you, her dad stayed in his lane, and that family is going to benefit for generations to come because one man stayed in his lane. Extra due diligence is absolutely vital at this time in our market. It's absolutely vital. We are crowded with investors. We're crowded with opportunities. There's seminars every week on every street corner. You have got to do extra due diligence on your assets and on all your trades. Make sure that who you're dealing with really owns that stuff. Make sure that you have done due diligence on your counterparty. And above all, make sure that you do diligence on the co-investors that you may be doing business with. The last thing I'm going to tell you in my last 60 seconds, because I will be gone in 60 seconds, there's a joke, is with more money chasing fewer good deals, prices will go up. Please remember this. Equity is illusory. It can be there and then gone. Ask me how I know. I had it at 43 and I didn't get it back until I paid them all off. 12 years, 13 years later. A millionaire at 43 and negative net worth 2 years later. Nothing else changed. Values crashed. Risky debt and borrowers will collapse. I will call it out now. I think that the multifamily, the large multifamily market is frothy hot. Look out below. And the last thing I want to share with you is cash flow is king. Predictable, consistent cash flow is king. And I bet you Ryan Parsons is saying amen, amen, and amen. I know Eddie and Martha are saying the same thing. And with that, I'm gone in 60 seconds. Peace.